Hello, good morning everyone. Please come to bond valuation chapter again. What we have studied till now, I'll just revise. We have studied the calculation of present value of bond. So under that we have seen coupon bond, that is annual coupon paying bond. We have seen semi-annual coupon paying bond, semi-annual coupon paying bond. In semi-annual coupon paying bond, you will make three adjustments. Required rate of return, if it is given per annum, you have to divide by 2 coupon rate divide by 2 and number of years multiply by 2. Number of years multiply by 2. Number of years multiply by 2. Okay. We have also seen the perpetual bond. Perpetual bond present value is annual coupon upon required rate of return. And then we have also seen zero coupon bond. Zero coupon bond or deep discount bond, the present value is equal to face value or redemption value upon 1 plus r to the power n. Required rate of return, r is required rate of return to the power n. And then we have also seen self-amortizing bond. So this is just a quick revision of what we did in the first lecture. Self-amortizing bond, you will calculate present value of coupon plus installment of principal of all the years, and that will give you the present value of self-amortizing bond, sum of the present value of coupon plus installment of the principal. Is it right? So this is what we have done. And the fifth thing we have done was clean price and dirty price. The concept of clean price and dirty price is required when you have to value a bond between two interest payment date. Okay, when you have to value the bond between two interest payment date, then will follow clean price and dirty price. Clean price means X interest price, dirty price means cum interest price, that is price including interest accrued. Clean price means price excluding interest accrued. So we will take one more question on this clean price and dirty price. A similar question has been asked in the past exam. So we just mention here past exam question. And then you also mention here important. Right? This way you will be able to understand better. This question you have to revise one day before the exam. Okay. So let us come to question number 16. Consider a bond with the following features. Face value is rupees 1 lakh. Coupon rate is 12% payable semi-annually. Question number 15 was interest was payable annually. So I have taken two examples and you will get one of this example. Either you will get a question where coupon is paid annually, or you will get a question where coupon is paid semi-annually, means after every 6 months, at the end of June and December. Required rate of return is 10% per annum. Valuation date is 1st October 2010. So you have to value this bond on which date? 1st October 2010. This is the valuation date. When was the last interest paid? The last interest was paid when? 30th June. The last interest was paid on 30th June 2010. And when will the next interest be paid? Next interest will be paid on 31st December 2010. So basically there is a gap of 3 months here, and also there is a gap of 3 months here. So interest has accrued for 3 months. Interest has accrued for 3 months. And when will this bond mature? The bond will mature on 31st December 18. This is the maturity date. So what we'll do? First we'll calculate the value of the bond on the next interest payment date. Okay. Then you will add the interest for 6 months. That will give you dirty price on 31st December. Then calculate the present value here. That will give you dirty price on 1st October. Then you deduct the interest accrued, and that will give you clean price on 1st October 2010. Is it right? So that way we will solve. Write down. First we'll draw one timeline. So students will write "30th June 2010 is the last interest payment date. 1st October 2010 valuation date. 1st October 2010 valuation date. 31st December 2010 is the next interest payment date. 31st December 2010 is the next interest payment date. Then 31st December 2018 is the maturity date. Now, if I have to value the bond at this point, I have to see how many coupons are pending. So 31st December 10 and 31st December 18 means there are 8 years. 8 into 2, 16 times coupon is pending. 16 times coupon is pending. And then on maturity date, you will receive 1 lakh rupees principal also. On the maturity date, you will receive 1 lakh principal also. So if I have to value the bond on 31st December, I have to calculate the present value of coupon, and I have to calculate the present value of this face value which I am going to receive. Is it right? Have you drawn the timeline? Okay. So now you start writing step 1. Step 1 will be clean price on 31st December 2010. Clean price on 31st December 2010. Then you write there calculation. I will show how to do it. Once again, 6000 into PV annuity factor in bracket 5%, comma 16 year. 5% comma 16 year. How much is the answer? Those who are attending can please reply. What is the answer for step 1? Step 1 is clean price on 31st December 2010. If you are given semi-annual bond, required return will be divided by 2, number of years will be multiplied by 2. So kindly reply, what is the present value on 31st December 2010? Yes, anybody wants to reply? Waiting for your answer. One student has said, Divya has said 57892. 57892 is not right. So 6000 into, first you calculate annuity factor 10.8378 plus 1 lakh into present value factor 0.4581. So the answer comes to 1,10,836.80. Is it right now? So this is the right answer. Students who are in the classroom, they are saying that it is right. So we'll go with this answer, and those who could not get it, please check it again. If you have doubt, then ask me. Other student can also reply. Okay, so now I'll go to step 2. So we have got the clean price on 31st December. I will add the coupon of this date also, because that is also pending. So that will give me dirty price. So write down step number 2. Step number 2, write down dirty price on 31st December 2010. Dirty price on 31st December 2010. Dirty price on 31st December 2010. Right there, the previous answer write down plus 6000. Previous answer plus 6,000. 6,000 is the coupon payment for 6 months. Right? So how much you are getting? 1,16,836.80. Now just understand one more time. This is 31st December 10. We have to calculate the value on 1st October 10. So what is the gap here? 3 months. Is it 3 months gap? So we have to discount it by 3 months. But this is a question of semi-annual coupon payment. This is a question of semi-annual coupon payment. So therefore, I will do the calculation keeping in mind that one period is equal to 6 months. Is it right? So write down step number 3, calculation of dirty price on 1st October 2010. Calculation of dirty price on 1st October 2010. Take the previous answer, 1,16,836.80 divide by, now how do you compute present value? It is a semi-annual bond. So interest rate or required return, which is given as 10%, will take 5%, 1.05, and power will be, one period is equal to 6 months. So 3 divided by 6. 3 divided by 6. 3 divided by 6 means we will take half of the 6 months period. So you will get on the right side 1,16,836.80 divided by 1.05 to the power 5 to the power 0.5. Now when the power is 0.5, you can just press square root once. Okay, just type 1.05, press square root function, and you will get this value. When the power is 0.5 means power is 1 by 2, you can get the answer by simply using the square root function once. Okay, are you getting this answer? So my answer is 1,14,021 dirty price on 1st October. Now the answer is not over. What is pending? Clean price is pending. So what you will do? What will you do? Interest will be deducted. Interest will be deducted. Right. So write down step number 4. Step number 4. Calculation of clean price. Calculation of clean price. Calculation of clean price. First, I will compute accrued interest for last 3 months. So clean price is equal to dirty price on 1st October 2010. Dirty price on 1st October 2010 minus interest accrued for last 3 months. Minus interest accrued for last 3 months. Minus interest accrued for last 3 months. So go to the previous answer. This was the dirty price and this is the interest accrued for last 3 months. 1 lakh into 12% into 3 by 12. Interest accrued for last 3 months. So what is the answer now? What is the answer now? This time the answer is very easy. Interest accrued is 3,000. So final answer is clean price is 111,021.05. Have you got it right? All of you got it right? Please say yes. Students at home, can you please say yes or no? Have you understood? Have you understood? Okay, Roshni and Divya, you have understood, very good. Now come to next paragraph, bond valuation and time to maturity. Bond valuation and time to maturity. So the value of the bond approaches its par value as the time to maturity approaches its maturity date, other things remaining the same. So suppose this is the par value of the bond. Okay, maturity, this is the maturity date. If the bond is trading at a premium, as the maturity will appear, its value will become closer and closer to par value. So initially it may be at a premium, but as the maturity will approach, the value of the bond will become closer and closer to par value or redemption value. Okay. So as the maturity approaches, a premium bond decrease in value. So if it is a premium bond, its value will decrease and become equal to its par value on maturity. And what happens to a discount bond? Suppose the bond is at a discount. Its value will increase and it will become equal to its par value on maturity. Is it right? So a discount bond value will increase slowly and it will become equal to its par value or redemption value on maturity. As the maturity approaches a par value bond, suppose it's a par value bond only, then doesn't matter, its value will remain same, it will remain at par only. If it is a 1,000 rupees bond, it will remain 1,000 only. then for the above relationship to be true, the maturity of the bond must be equal to its face value. So when will this equation be satisfied? When the maturity value is equal to its par value. Okay, so this you can remove. You can draw this diagram if you want for this paragraph. Kindly draw this diagram just for understanding what they are trying to say. If it is a premium bond, as the maturity will approach, the value of the bond will move towards its par value. That means its value will decrease. If it is a discount bond, it will move towards its par value. That means its value will increase. And if it is already a par value bond, it will remain par only. Its value will not change. Okay. So this is first discussion, that is where we have learned the calculation of value of bond of different types and on different dates. So just quickly summarize what we have done. The story till now was like this: the price of the bond today is equal to cash flow discounted with the required rate of return. Is it right? That is also called intrinsic value. The price of a bond is equal to face value. It means coupon rate and required rate of return are same. Coupon amount is equal to coupon rate into face value. Do not multiply coupon rate into price of the bond. And for coupon paying bond, which is also called straight bond, the intrinsic value is equal to, which we did just now, coupon amount into PV annuity factor plus redemption value into PV factor. You can either use the formula or you can use the tabular format for finding the present value of a coupon bond. In case of deep discount bond or zero coupon bond, take the face value or redemption value and multiply by PV factor. In case of perpetual bond, the intrinsic value is annual coupon upon required rate of return. Clean price of the bond is dirty price, also called full price minus accrued interest. Is it right? Now the second part of this chapter or the next part of this chapter is understanding the types of yield. What is yield equal to? Yield means return. Very good. Yield means return. When you are investing in a bond, you should know how much return you are going to earn, how much return you have earned, so that you can compare with different options. Is it right? If you look at only coupon rate, is coupon rate equal to yield? No, because the bond may be issued at a discount, or the bond may be issued at a premium, or the redemption may be at a premium, so that will affect your return. Is it right? In case of bond issued at par, redeemed at par, coupon rate and yield will be equal. But if the bond is issued at par, premium or discount, redeemed at premium or discount, then the yield is not equal to return. Okay. So there are different types of yield associated with bond. Any of these can be asked in the exam. Holding period yield, money market yield, bond equivalent yield, yield to maturity, realized yield to maturity, and current yield. So we are going to learn these 6 types of yield. All of these are in your syllabus and they can be asked in the exam any point of time. So let us first learn holding period return or holding period yield. In short, we will call it HPY. Okay. Now it is very simple. This is simplest. Suppose it is 1st January 2024, 31st December 24. You purchased a bond here for, let us say, 1000 rupees. You purchased a bond on 1st January 24 for 1000 rupees. On maturity, the value of the bond is 1050, or the price of the bond after 1 year is 1050, plus in this 1 year period you also received coupon 80 rupees. You received a coupon of 80. Question is, how much rate of return you have earned? Can you calculate how much rate of return you have earned? Put yourself in the place of this investor. You bought a bond for 1000 rupees. At year end, you got a coupon of 80 and you got the price of the bond as 1050. How much return did you earn? Yes, reply please. How much return did you earn? How much return did you earn? Anybody who wants to answer? One student said 13%. Very good. Is it 13%? How did you get 13%? You invested 1000 and you received 1130. So 130 rupees you earned by investing 1000 rupees. So that is 13%. Is it right? So that is how we calculate the holding period yield. Holding period yield is the total return received from holding an asset or portfolio of asset over a period of time. Is it right? And we will answer in percentage. We will not write 130 rupees. We will write 13%. And how do you compute it? The formula is what you did just now. Income plus end of the period value minus initial value divided by initial value. So let us check whether this formula is right. When you invest in a bond, there are two types of income you get. One is the coupon income. How much was coupon income? 80. And one is capital gain or loss. So you got 1050 and you had invested 1000 rupees, which means 50 rupees was your capital gain. So coupon income plus capital gain together is your total return, and divide by the amount you invested. So the amount you invested was 1000 and hence the answer is 13%. So what we'll do, we'll apply the simple formula, but there is no need to remember the formula. It is the income from coupon and capital gain or loss on bond divided by the amount you invested in the beginning, initial value, and that gives you the return on the bond. So we'll take one question 17 which is printed below. This question was asked in RTP long back, but still it was asked in RTP, so it is relevant. A have purchased a bond at a price of rupees 800 with a coupon payment of 150 and sold at rupees 1000. 1. What is his holding period return? If the bond, second question, if the bond is sold for rupees 750 after receiving 150 as coupon payment, then what is his holding period return? Is it right? So first what you do, first write this formula. Write this formula. Holding period return is equal to income plus end of the period value minus initial value divided by initial value. So there are two cases. Case 1, holding period yield is equal to, what is your coupon payment here? 150. In the case 1, what is the end of the period value? 1000. And what was the Initial value 800. Very good. Divide by 800. Students will give me the answer. Yes, Roshni, Soumya, Divya. Into 100. So 43.75% is right. Divya is right. Case 2 right. HPY. Now what they have done, coupon will be same, but the end of the period value is 750 minus 800 divide by 800. So how much is the answer now? Come on, Roshni. Yes, Amol, come on. Please reply fast. 12.5%. 12.5% is right. So this is how you will calculate the holding period return. How much return did you earn during the period you are holding the bond? How much return did you earn during the period you are holding the bond? So that is called holding period return. Is it right? Now we'll come to next kind of yield called money market yield. Now let us say you purchase the bond on 1st January 24 and you are holding the bond till 30th June 24. So this is a 6 months period. Your holding period yield, let us say, is 10%. But that is 10% for how many months? 6 months. If I have to find out what is the equivalent annual yield, because to compare with other instrument in the market which are quoted per annum, you have to convert this also into per annum. So when we convert the holding period yield into per annum, that is called money market yield. So the interest rate earned by the investing in security with high quality and maturity of less than 1 year, such as certificate of deposit, treasury bill. There is a chapter also in our syllabus, money market. So this instrument, money market instrument, have short duration, short maturity, like certificate of deposit are for 6 months or 9 months. Treasury bill may be for 3 months, 6 months, 9 months, but the rate of return is expressed in per annum terms. So what I will do, I will first calculate the holding period yield. First I will calculate, that means if suppose I am holding the treasury bill for 3 months, so for 3 months I will calculate and then annualize it. How do I annualize? Like in this example, if in 6 months you are earning 10%, then in 12 months how much you are earning? If 6 month return is 10, then 12 month is how much? 20%. So what you will do, you will take 10 into 12 by 6. So it will automatically become 20% per annum. And if suppose the problem is given in days, like they say you are holding for 181 days, then you will take 10 into 181 or divide by 365. Number of days, if nothing is given, take 365, but if number of days are given as 360, then you will take 360. In some problem they will say number of days are assumed to be 360. So that is how you will convert holding period yield into money market yield. If months are given, multiply by 12 by n. If days are given, multiply by 365 by n. Now next is called bond equivalent yield. We will take a question on money market yield after some time. Bond equivalent yield. Bond market exhibits semi-annual feature. Bond market exhibits semi-annual feature because in most of the bond market, coupons are paid after every 6 months. So first what I will calculate? I will calculate the yield for 6 months. First I will calculate the yield for 6 months and then multiply by 2. So bond equivalent yield means first I will calculate the yield for 6 months. Treat it as if it's a 6 months problem. And once you get 6 months, to convert into per annum, what will you do? Multiplied by 2. If 6 month yield is 10%, annual will be 20%. So this is called bond equivalent yield. In short, we will write BEY. The formula is 1 plus holding period yield, 1 plus holding period yield to the power 6 by n, to the power 6 by n. Suppose you are holding for 2 months, then it will become 6 by 2. So you are actually multiplying by 3. Actually your power is 3. So that will give you the yield for 6 months and into 2. Okay, so that will give you bond equivalent yield. Now I am going to take one small question which will help you to understand how to calculate holding period yield, money market yield, bond equivalent yield, all in one. Question number 18. Welcome to question number 18. An investor purchased a bond at rupees 600 and sold it after 4 months at rupees 615 after receiving an interest of rupees 3. First question you will answer holding period yield. Second, you can answer money market yield. Third is effective annual yield. Here we will compute effective return earned in 1 year. And fourth, just now we have learned, which is called bond equivalent yield. Is it right? So let me see who will give me the correct answer of holding period yield. Yes, everybody please participate. Some of you are in silent mode only. Yes, holding period yield. Holding period yield. Come on, Divya 3%, Amol 3%. Right. So first write down the formula. Always start with the formula. Don't write directly in the exam. So you will present the answer very, very nicely. Holding period yield HPY is equal to income plus end of the period value minus initial value divided by initial value. Right? After writing the formula, put the values 3 plus 615 minus 600 divided by 600. What is the answer? 3%. This is holding period yield and this problem is for how many months? 4 months. So in 4 months if you earn 3%, in 12 months you will earn how much? That is called MMY, money market yield. Write down below money market yield. Money market yield. We have a chapter also called money market. Anybody for money market yield? Yes, Roshni. So you will write the formula first. Money market yield is equal to holding period yield into 12 by n. Holding period yield into 12 by n. So you will write 3 into 12 by 4. Write nicely. Write nicely. Then your answer is 9% per annum compounded every 4 months. 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 Is it right? Then we'll write down effective annual yield. Now first I'll explain, then you will understand better. Effective annual yield I am explaining. Students will not write, just wait. In this question, you are holding for how many months? 4 months. So suppose you have 1 rupee invested in the beginning. Suppose you have 1 rupee invested at the beginning. And what is your holding period yield? 3%. So 1 rupee will become 1 plus 3%, 1.03. Then after another 4 months, that means at the end of 8 months, 1.03 will earn another 3%. How much? 1.0609. 1.0609. And after another 4 months, that is at the end of 12 months, 1.0609 plus 3%. How much is that? 1.0927. So if you earn 3%, again you earn 3% on that amount, and again you earn 3% on that amount. How much amount you will have at the end? 1.0927. So 1.0927 minus 1, that is the amount you had invested, you got 0.0927, which is equal to 9.27%. This 9.27% is called effective return. I think in mathematics also there was some similar concept. When you were required to convert semi-annual return into effective annual return. Was it there in mathematics long back? Don't remember? Okay, no problem. So that is the logic of effective annual yield. But suppose it was a 12 months, 1 month return given, so you have to do this exercise 12 times. If suppose the holding period is 1 month, then I will have to do this 12 times. That is a time consuming process. So why can't we apply the formula? Because in formula also we are doing the same calculation. Write down. Now you can start writing effective annual yield is equal to effective annual yield. So effectively you are earning 9.27% per annum if it was annual compounding. Okay, 9% is per annum compounded every 4 months, which is equivalent to 9.27% compounded annually. Okay. Solve. How do you solve? 1 plus 0.03 to the power 12 by 4. 3 times return will be earned. 3 times. If one period is 4 months, there will be 3 times the return will be earned. Come on. To the power 4 minus 1. So how much is that? Solve it. Solve it. Come on. You should get the same answer. 9.27% per annum. But this time you will write compounded annually. This time you write compounded annually. 9% per annum compounded every 4 months is equal to 9.27% per annum compounded annually. The two answers are same but expressed in a different way. So effectively your 1 rupee will become 1.0927 after 1 year. Now write down next answer, bond equivalent yield. Bond equivalent yield. In bond equivalent yield, we will first compute the effective yield for 6 months instead of 1 year. Same thing, but we'll do it for 6 months and then multiply by 2. Write down 1 plus holding period yield to the power 6 by n minus 1 bracket close into 2. Solve 1.03 to the power 6 by 4 minus 1 into 2 into 2. So you will have to simplify that. 1.03 to the power 1.5 minus 1 into 2. Now the student is wondering how to solve it. So we have learned one trick on calculator. First you type 1.03, press square root 12 times, then press minus 1, then multiply by power 1.5, press plus 1 and then press multiply equal to 12 times. This is how you can solve when the power is in fraction. So I want you to give me the answer of this question. Please reply. So final answer we have got is 9.06% per annum. Write down compounded semi-annually. Write down compounded semi-annually. Compounded semi-annually. 9.06% per annum compounded semi-annually. Because we have first computed the yield for 6 months and then multiplied by 2. So this is how bond market gives you return. One more practice we'll do. Question number 19. Similar question, one more practice. An investor purchased a bond at the rate rupees 347 and sold it after 1 month. This is a question of 1 month holding period. 1 month at 343.20 after receiving an interest of rupees 0.70. Calculate same 4 questions. Again I will ask you to check whether you are awake or not, to check whether you are attending or not. Give me the answer of the first part, holding period yield. Give me the answer of HPY. Yes, anybody? Holding period yield. Those who are attending online, offline, and also on the YouTube channel. This lecture is live streamed. Yes, please reply. Roshni, Soumya, Sumaya, Hari, Divya. Just apply the formula. HPY is equal to income plus end of the period value minus initial value upon initial value. If you get answer in negative, that is also okay. Okay, don't worry, the answer can be negative. Purposefully I have given this question because there can be negative answer also. Holding period yield can be negative also. So the answer is yes.
Minus 0.89.
Very good. 0.89 negative for 1 month. So the return is minus 0.89 percentage for 1 month. Roshni has replied 0.8933. It is not minus 89.33, it is minus 0.89. Minus 0.89. Divya has replied 8.9, which is not 8.9, it is minus 0.89. Do the calculation. You can't make mistakes in calculation part. Okay. So 0.89% for 1 month. And when you multiply this by 12, it will give you money market yield. Okay. So write down money market yield. This time write little fast. Money market yield is equal to HPY into 12 by N. HPY into 12 by N. HPY is minus 0.89 into 12 times because holding period is 1 month. So the answer is minus 10.68% per annum compounded monthly. You have to write full per annum compounded monthly. Check the calculation. Compounded monthly. Is it right? Now I will calculate effective annual yield. Effective annual yield EAY. Formula is 1 plus holding period yield to the power 12 by N bracket close minus 1. Now this time your return is negative. So here instead of plus, while solving you have to deduct 0.89 from 1. Is it right? So purposefully this question is given so that if you get negative holding period yield, don't get scared. Now I'll put the numbers like this. 1 minus you got 0.89% which is equal to 0.0089. Is it right? And because you have got negative return, I'll put a negative sign here, minus. So 1 minus 0.0089 to the power 12 by 1 in minus 1. So you have to solve. Please reply little fast. Yes, anybody wants to answer? Come on. Yes, come on. What is your answer? Minus 10.17% per annum compounded annually. Compounded annually, write down. Is it right? And now the next calculation is bond equivalent yield. So here first we'll do the calculation for 6 months and then multiplied by 2. So write down bond equivalent yield is equal to 1 plus holding period yield to the power 6 by N minus 1. So that gives you yield for 6 months into 2 into 2. So what is your answer now? I'll put the numbers. You will solve. Yes, please reply. Solve and answer, please. Come on. Divya, Roshni, Amol, come on, answer. You have to learn to use your calculator. These are type of questions from exam only. The answer is, final answer is minus 10.445%. Is it right? Yes, per annum, compounded semi-annually. Compounded semi-annually. Compounded semi-annually. So that was, so we have studied so far how many types of yield: holding period yield, money market yield, bond equivalent yield, effective annual yield. Okay. But the most important yield in this chapter is yield to maturity. Yield to maturity. Roshni said 10.46. You are right. 10.46 you can write. Now the next issue is yield to maturity. What is the meaning of yield to maturity? Suppose you buy a bond for 990 rupees. You hold it for say 4 years. Year 1, 2, 3, 4. You receive 90, 90, 90 as coupon. In the last year you receive 90 plus, let us say redemption value is 1050. So this was your investment in the beginning and these were your inflows. Am I right? So the question is, how much rate of return you have earned? What is the rate of return you have earned if you hold the bond till the maturity? What is the rate of return you have earned if you hold the bond till maturity? Wait, we have to also give importance to time value of money. You just can't add 90, 90, 90, 90 and 1050. In yield to maturity, we have to also give importance to the time value of money. Is it right? So yield to maturity means what is the rate of return the investor will earn if the bond is held till maturity. And to simplify it for you, we also call it IRR. Is it right? Have you ever heard in your lifetime what is IRR? What is IRR? Effective interest rate. IRR means effective interest rate. What is effective interest rate? What is effective interest rate? It is that rate of discount at which present value of future cash inflow is equal to present value of cash outflow, or you can say it is that discount rate at which net present value is 0. Is it right? Have you not studied IRR in your intermediate? IRR is that discount rate. IRR is that discount rate at which NPV is equal to 0. Net present value 0. That is, PV of inflow is equal to PV of outflows. So you have to find that discount rate at which your PV of inflow is equal to PV of outflow. Okay. So I am not going to teach you IRR today. I am assuming you have studied IRR somewhere before. Otherwise, how you will reach final? Unless you keep that capital budgeting topic as an option, you can't pass this intermediate exam. Okay, by learning IRR. There are two ways we can get IRR. If it is a coupon bond, there is a formula printed in your book. This formula write down. For coupon bond, what is coupon bond? A coupon bond is a bond which pays periodic coupon and the amount is redeemed on maturity. First they will pay coupon for 5 years, 6 years, 10 years, and then on the maturity date the face value is redeemed. For that type of question, you can apply the formula. The formula is C into 1 minus T, formula is printed in the book, plus RV minus CP. In your book NP is written, it's okay, divide by number of years to maturity upon RV plus NP by 2. What is C here? Coupon interest. T is tax rate. RV means redemption value. CP means current market price, and N means number of years. Oh, this formula, sir, we have learnt in calculation of cost of debenture also in the intermediate. You are right. Cost of debenture is nothing but the rate of return to the investor. If tax rate is given, then we will use that. it will give you post-tax return. It will give you post-tax return, and if you don't write 1 minus t, this will give you pre-tax return. Is it right? Pre-tax return means I have not considered tax effect. Post-tax return means I have considered tax effect. Okay. Now, is this formula correct or there is some problem with this formula? Time value of money is not considered. This formula has a limitation. Redemption value may be after 20 years. Current price is given today. So you are adding two numbers which are separated by 20 years. So don't you think you are ignoring time value of money? Yes, we are ignoring time value of money. So this formula gives you approximate answer. I have written in the notes also. This formula does not give you accurate answer. Okay. So first thing you have noted, the formula will be used only for coupon bond. Do not use it for perpetual bond. Do not use this formula for zero coupon bond. Do not use this formula for self-amortizing bond. Second thing, the formula method gives you approximate right answer but not accurate answer because it ignores time value of money. So this I have given in that important point notes. Okay. Now some important discussion below. There is one example printed in the book. Write down that example as homework. There is one example printed in your book. Suppose an investor is considering the purchase of a 5-year 1000 rupees bond. So do it as an homework because I am going to take a similar question in next few minutes. Now I am going to give you one important information about relationship between YTM and coupon rate. This we have discussed in question number 1 also. If coupon rate and YTM are equal, okay, and assuming that the redemption will be at par, then the present value of the bond will be equal to its face value. If coupon rate is greater than YTM, the bond will be trading at a premium today. That means when your YTM is less than coupon rate, can I say that? The bond will be trading at a premium. In question number 1 also we have written the same thing. If required return is less than coupon rate, the bond will be trading at a premium. So present value of the bond will be more than, the price of the bond will be more than its face value. But if coupon rate is less than YTM or YTM is greater than coupon rate, it means the bond will be trading at a discount. That is, the price of the bond today is less than its par value. Okay. These are important hints while solving the problem. If you find that a bond is trading at a discount, it means its YTM will be greater than coupon rate. And if you find that it is trading at a premium, it means its YTM is less than the coupon rate. And if you find that they are equal, face value and price is equal, it means the YTM and coupon are equal, subject to the redemption is at par. Okay, I have written a note here, subject to that the redemption is equal to face value. So now today we will solve few questions. Question number 20. We have to first check whether it is a coupon bond or not a coupon bond. If it is a coupon bond, I can solve by applying the formula, or I can also solve by using IRR method. Have you studied IRR? Yes. Roshni is saying yes. So we will solve by IRR method also. Okay. So question is, a 5-year bond with 8% coupon rate and maturity value of rupees 1000 is currently selling at rupees 925. what is its yield to maturity. Before we go ahead, the student is requested to answer. Current price is 925, face value is 1000, coupon rate is 8%, whether YTM will be more than 8, less than 8 or equal to 8%. Participate. More than 8, less than 8, that means without solving only, you have to give me the answer whether YTM will be greater than 8% or less than 8% or equal to 8%. Yes? Less than. See this table, you are here. It is a discount bond. If it is a discount bond, YTM is greater than coupon rate. If you are using a higher discount rate than 8%, then only the present value will be less than 1000. So your answer must be greater than 8%. If you are getting an answer less than 8%, it means you have made mistake in the calculation. Solve. Write down YTM is equal to C plus FV means face value minus CP means current price divided by N upon FV plus CP by 2 upon FV plus CP by 2. Okay. When you are writing an answer in the exam, then you must explain the terms used in the formula. C stands for coupon, FV stands for face value, CP stands for current price, and this N stands for number of years. In the classroom we will not write these details in every problem, but in the exam you must write, otherwise some examiner can deduct marks for this also, right? So now put the values and solve. Please reply little fast. 80 plus 1000 minus 925 divided by 5 upon 1000 plus 925 by 2. What is the answer?
20.77.
The final answer is little more than 8%, 9.87%. 9.87%. 9.87%. Okay. Check the calculation. 9.87%. Is it right, everybody? Yes. Now what I'll do, I will solve by IRR technique also. Sometime in the exam they specifically ask you to solve by IRR method. That means you have to give importance to time value of money also. So what do you do in IRR method? You take one assumed discount rate and you think that this can be your IRR, calculate NPV at that assumed rate, okay? If you get 0 NPV, that is the IRR. But if you get positive NPV, then you have to increase the rate, because higher the rate, lower the NPV. So we have to bring the NPV to 0. And if you get negative NPV, you will decrease the rate. It means you have taken little higher rate, so why don't you reduce it slightly? Is it right? Now this question we have already solved under formula method. Under formula method my answer was 9.87%. So under IRR method it will not be different from this. It will be slightly different, because under IRR we are also taking into account time value of money. Am I right? So we will take one rate as 9 and one rate as 10, and we'll apply the interpolation method. This method is called interpolation. You must have studied in mathematics or in IRR class interpolation. So now solve. Draw the format first. This is the format we will use in your entire syllabus for IRR or YTM calculation. Okay. Year, cash flow, discount rate 9%. Under that two columns, discounting factor and discounted cash flow. Write little fast. Discount rate 10%, under that two column, discounting factor, discounted cash flow. DCF means discounted cash flow, or you can just write present value. Okay, you can just write present value. So draw the format. Once your format is over, you will say yes sir, then I can proceed further. Is the format over? So first I will write the cash flows of this question. In year 0, there is an investment in bond 925. Then for 5 years, you will receive coupon 80 rupees, and in the 5th year, you will receive 1000 rupees redemption value. Okay, you will receive 1000 rupees redemption value. So now what we'll do? We'll calculate the discounting factor first. Year 0 always 1. Calculate on your calculator annuity factor for 5 years at 9%. Is it 3.8897? Very good. Next. Last 5th year factor, write down 0.6499. Now multiply 925 into 1, same, 80 into 3.8897, 311.176, 649.90. Take the total. Anybody total of this column? Total. Total is 36.076. I got it. Now this is positive NPV. So should I increase the rate or decrease the rate? I will increase the rate, because if I increase the rate, NPV will move towards 0. Okay, so I'll increase the rate by 1 or 2% because it's very close to 0. So let us take 10%. Let us take 10%. Then solve at 10% now. Year 01, factor for 10% and 5-year annuity 3.7908, then 0.6209. Multiply 925 into 1, 80 into 3.7908, 303.264, 620.90, 620.90. Total of the last column is 0.836. 0.836 approximately, negative. Approximately, it is close to 0.836. Okay. One is positive, one is negative. If one is positive, one is negative, what does it indicate? That the answer is between 9 and 10. It is more than 9, but it is less than 10. So therefore we have to apply a formula to get the answer. So this formula is like this. YTM is equal to, if you know any other formula you can write that, answer will be same. YTM is equal to start rate means 9%, okay, the lower of the two rate, plus surplus means NPV at lower rate. Surplus means NPV at lower rate upon surplus plus deficit into bracket end rate minus start rate. We can write like this also if you have studied like that. Suppose you have studied in intermediate, right? YTM is equal to lower discount rate plus NPV at lower discount rate upon NPV at lower discount rate minus NPV at higher discount rate into the difference between higher discount rate minus, this is what they teach you, yes or no? Yes, this is also okay. You are doing the same thing. So whatever comforts you, you follow that. If you think this is taught to you, follow that. If this is taught to you, follow that. So now tell me, you will have to give me the answer. Lower discount rate was 9%, right? And what was the NPV at the lower discount rate? 36.076. 36.076 upon 36.076 minus, in bracket again minus, how much was that? 0.836 into bracket 10 minus 9. So 9 plus 36.076 minus will become plus. Minus will become plus. So 36.076 plus 0.836. So that is 36.912 into 1. Now you can give me the answer.
9.98.
Around 9.98%. 9.98%. This is how you compute the IRR. Okay, 9.98%. Got it? Yes. Is everybody getting 9.98%? So what is the logic of this formula? I hope you are taught in your intermediate syllabus. Yes or no? Not taught. I'll just explain briefly because today's topic is not IRR. So see the logic of this formula. When the discount rate is 9%, NPV is 36.076. When the discount rate is 10%, NPV is minus 0.836. So what is the change in NPV? Change in NPV from 36.076, it has become minus 0.836. So the change in the NPV is 36.912. And what is the change in discount rate? Change in discount rate is 1%, from 9% to 10%, which means a 1% change in discount rate. A 1% change in discount rate will produce a change in NPV of 36.912. Is it right? 1% change in discount rate will produce 36.912 change in NPV, but I don't want to change NPV by 36.912. I want that this number should become 0. So I want to change it only by 36.076. If this number is reduced by 36.076, my NPV will become 0. So then by what percentage the discount rate should change? Then by what percentage the discount rate should change? So we'll do cross multiplication. 36.076 into 1 divided by 36.912, which comes to 0.98. Is it 0.98? So 9 plus 0.98, that is what I have written here, 9, and this whole thing is 0.98. 9 plus 0.98 is 9.98% is the IRR. That was the simple logic of IRR calculation. Is it right? So that was my answer. Now we'll come to question 21. Question 21. In the exam, you can either solve by formula method or IRR method. Question number 21. Question number 21. A bond of rupees 10,000 bearing coupon rate 12% and redeemable in 8 years at par is traded at 10,600. So my question is whether YTM will be less than 12% or more than 12% or equal to 12%. If the bond is trading at a premium, tell me quickly, if the bond is trading at a premium, so your YTM will be less than coupon rate. YTM will be less than coupon rate, because if you use a lower discount rate, present value will be higher. So you should get an answer which is less than 12%. Okay, so students are right. So write down the formula. Write down the formula first. It's a coupon bond. I can use the formula. Yes, very good, Roshni. After writing the formula nicely, put the values. Put the values. Put the values. The coupon amount will be 12% of 10,000, that is 1200, plus in bracket write 10,000 minus 10,600 upon 8 upon 10,000 plus 10,600 divided by 2. Quickly reply. Please reply fast. So the answer is 10.92%. As we discussed that the YTM must be less than 12%. So 10.92, is it right? Check again. 10.92, yes. Please say, is it right? Write in chat box, yes sir, it is right. $10.92. Okay, next is question 22. We'll first take some basic question, then we'll move to advanced exam oriented problem also, because first we need to revise, we need to make your concept stronger. A rupees 5,000 bond with a 10% coupon rate matures in 8 years and is currently selling at 97%. Currently selling at 97% means what is the current market price? Current market price, write down 97% of 5,000. How much? 4850. Its face value is 5,000, but current market price is 4850. Coupon rate is 10%, maturity is 8 years. Is this a desirable investment for an investor whose required rate of return is 11%? Now it's a decision making question. Suppose my required rate of return is 11%. Would I like to invest in this bond? Would I like to invest in this bond? So there are two ways you can solve the problem. First method is find out the price intrinsic value at 11%. Find out the intrinsic value at 11%. So you will calculate intrinsic value using 11% discount rate. If the current market price is below the intrinsic value that you have calculated, then you will buy the bond. If the current market price is less than intrinsic value is what you are willing to pay. If the current market price is below that, you will buy the bond. Second method is compare YTM with required rate of return. Is it right? Compare YTM with required rate of return. Your required return is 11, but if the YTM is greater than 11, what will you do? You will buy the bond. If the YTM is greater than 11, you will buy the bond. So one option is compare current market price versus intrinsic value. Second method to solve is compare YTM and required return. So I will first compute YTM. If YTM is more than 11%, I will be happy to buy this bond. So start. YTM is equal to C plus FV minus CP upon N upon FV plus CP by 2. After writing the formula, put the values. What will be your coupon? 5,000 into 10%, 500 plus in bracket 5,000 minus 4850 divided by 8 upon 5,000 plus 4850 divided by 2. Kindly answer. Yes, please reply. Yes, please reply. 10.53%. Is it 10.53%? Very good, Roshni. What happened to other students who are learning at home? You have stopped replying only. Only few students are replying. 10.53%. And how much is your target return? 11%. But the bond is giving you less than 11%. So would you buy? No, I will not buy because it is giving me less return. So write a note, write the conclusion as the YTM is less than, required return. As the YTM is less than required return, the bond is overvalued. The investor should not purchase the bond. The investor should not purchase the bond. The investor should not purchase the bond. Is it right? The investor should not purchase the bond. Now we'll go to another way of solving the same question. Write down alternatively. This time we'll compare intrinsic value with current market price. And intrinsic value will be calculated using 11% discount rate. So write down alternatively. This is method 2. In the exam, just apply one of the two methods. Calculation of present value, or you can say intrinsic value of the bond. So we have to calculate present value at 11%. You write down year, cash flow, PV factor at 11%, PV factor at 11%, and last column PV. Is it right? Then first 8 years you will get 500 rupees cash flow. First 8 year you will get 500 cash flow. Then 8th year 5000 cash flow. Take your calculator and calculate annuity factor for 8 years at 11%. Yes, please answer. 8 years 11% annuity factor. How much is that? 5.1461. Very good. Next, 8th year factor. Only 8th year factor. 4339. Multiply and take total. Multiply and take total. 2573.05. 2169.50. 2169.50. Total is 4742.55. You are willing to pay 4742.55, but the bond is trading at 4850. Yes or no? So the current market price is more than intrinsic value. Therefore, it should not be purchased because it is overvalued. So write down the conclusion. The investor should not purchase the bond as it is overvalued. The investor should not purchase the bond as it is overvalued. The investor should not purchase the bond as it is overvalued. The investor should not purchase the bond as it is overvalued. Okay. So this type of questions are asked in the exam. Now we'll take one exam question. Question number 23. Sorry, 20. This is 23. By mistake it is written 25. Question number 23 in your book. Tick mark important. Tick mark question 23 as important question because it is asked in the exam. There is a 9% 5-year bond issue in the market. What is 9%? Coupon rate. Is it right? And the time is 5 year. The issue price is 90. Issue price is 90 and the redemption price is 105. For an investor with marginal tax rate of 30%, marginal tax rate of 30% means on interest you have to pay 30% and capital gain tax rate is 10%. Capital gain tax will be applied when this bond will be redeemed because you will get a profit of 15 rupees when this bond will mature. So government will say, oh, you bought at 90, now you are selling at 105. Please give capital gain tax. So what will be capital gain tax? at the rate 10%, 1.5. So you will get redemption value of 105, but government will snatch away from you 1.50. So what is your net redemption value? How much net amount will come into your pocket? 105 you will get from the company, 1.50 tax you will pay to the government, so you will get 103.50. You will get 103.50 as redemption value. So this time my redemption value will be after considering tax. 1.50 I will get less. So students make a mistake in this question. Student just write 105. He is forgetting that out of 105 I have to pay 1.50 as tax. Question is, and there is no indexation also. So you have to take directly 90 for calculation of capital gain. What is the post tax yield to maturity? So when they say post tax yield to maturity, you have to consider tax implication. How much coupon you will earn? How much coupon you will earn? So first check face value of the bond in the question. This question has a mistake. They have not given the face value of the bond. So what will you assume? If face value of the bond is not given, but the issue price is 90, redemption price is 105, what face value you can assume? So we will assume face value as 100 rupees. We will assume face value as 100. So coupon will be 9% of 100. How much will be coupon? 9 rupees. But government will come and take 30% of that. So what will be your interest net of tax? What will be your interest net of tax? 6.30. So while solving the question, you will take interest net of tax. You will take redemption value net of tax. Is it right? So first I'll prepare a small working note on net redemption value. Otherwise directly if I write you will not understand. So students are requested to first prepare a small working note, net redemption value. Right hand side rupees. Right hand side rupees, write down point number A, redemption value. Redemption value is 105. Issue price is 90. Issue price is 90. Capital gain is 15. Correct? No indexation. So on capital gain you will pay tax. Tax on capital gain. Tax on capital gain will be 10% of 15. 10% of 15, 1.50. So net redemption value will be 105 received from the company minus 1.50 tax paid. Minus 1.50 tax paid. So therefore the net redemption value is 103.50. Is it right? So what mistakes students make? Some of them don't consider 1.50 in the calculation. They take 105 only in calculation. Second mistake they make, they take the difference between 15 and 1.50 as redemption value. How can that be the redemption value? Okay, so now write down formula. YTM is equal to C into 1 minus T, C into 1 minus T plus RV minus IP upon N upon RV plus IP by 2. Solve. Here this time we have included one more calculation, tax rate. Okay. So the answer will be, first put the values, 9 into 1 minus 0.3 plus 103.50 minus 90 divided by 5 upon 103.50 plus 90 upon 2. Yes, Divya, what is the answer? Divya is saying 9.3%. You are right. Amazing. Clap. So 9.3% is the answer. This is how you will solve if this question comes. There is one more way you can solve, and that is by applying IRR technique. Do you want to solve by IRR technique also? Let us practice one more IRR. Write down method 2. In the exam you are required to solve only once, but in the classroom we have to learn. So method 2, write down. Method 2, calculation of YTM using IRR. Calculation of YTM using IRR technique. Calculation of YTM using IRR technique. If specifically they ask in the exam IRR technique, then you follow that. Otherwise you can choose any of the two. In the formula method we have got 9.3%. So IRR method will also give you somewhere close to 9.3%. So I will take the lower rate as 9 and the higher rate as 10. Solve. Please solve fast. I think we have already written factor in one earlier question. So you can copy factors from there. Cash flow, write down. Year 0 you have to invest 90 rupees. Year 1 to 5, you will get interest of 9 rupees, you will pay tax 30%, so your cash flow will be 6.30, and in the last year your net redemption value is 103.50. Net redemption value is 103.50. So with that, solve now. Factor we have already calculated in question number 20. So maybe you can just copy from there little fast. Question 20. Multiply cash flow and factor. Take the total. It comes to 1.77. Check. It comes to 1.77. Right? Then it is positive or negative? Positive. Increase the rate 10% now. Take 10%. 10%. Factor I have computed in question 20. Just copy from there. Copy from your notebook. Question number 20. Solve. Calculate the net present value. This time it is negative 1.855. Okay, so now you will answer what is IRR. Please reply, everybody, those who are attending offline, online or on YouTube. Anybody got the answer? IRR. So you will get 9.49%. Check. You will get 9.49%. approximately write down, because some difference is possible. So if you are getting close to 9.49, you are okay. Write in bracket approx. One student got 9.46. 9.46 is also okay. 9.46 is also okay, don't worry. Just write in bracket approximately. Okay. Now we'll take one more important question, which so far they have not asked in the exam. But if they ask, you should be able to solve. Question number 24. Question 24. A semi-annual, underline. In your book, I think there is a small typing mistake. Semi-annual coupon paying bond. Semi-annual coupon paying is not printed. Please write it down. Semi-annual write down, has following features: face value 1000, original maturity 10 year, remaining maturity is 5 year. So we have to look at the remaining maturity. We have to look ahead, not what happened in the past. So remaining maturity is important. Issue price is 990. Current market price is 962. Coupon rate is 12%. So we have to look at this current market price, because if I purchase the bond today, how much amount I have to pay? 962, not 990. 990 was paid earlier, but today we have to purchase the bond for 962. Okay, then coupon rate is 12%, income tax rate is 30%. So income tax rate 30% will be applied on coupon, and capital gain tax rate is 10%. So you will purchase the bond for 960 and you will redeem the bond for 1000. So there will be some capital gain, 38 rupees. On that you pay 20% tax. One more tax issue is involved. There is a tax rebate of 20% on investment in this bond. This is one more variable we have added. There is a tax rebate of 20% on investment in this bond. So tell me, what will you do with this 10% tax rebate of 20%? So when you will purchase the bond for 962 rupees, government will give you tax rebate. So your investment amount will reduce to that extent. You pay 962 and you immediately get tax rebate of 20%. So my investment will be 962 minus 20%. Is it right? So that will help me to increase my rate of return. Again, the question is calculate post-tax YTM. Got it? So first what I'll do, first I'll prepare a working note, net initial investment. As you know, when you invest in certain bond, you get tax rebate under section, which is that section? Income tax section 80. Okay, don't remember, I also don't remember. But by investing in certain bond, you get deduction and exemption. Is it right? So write down first step 1, net initial investment. Net initial investment, right hand side rupees. First point A, current price of the bond. We'll take current price, because if I buy the bond today, I'll pay 962. These are some important questions for exam purpose. Less tax rebate at 20%. Immediately I will get tax rebate at 20%. By investing in certain bonds, you get tax rebate, tax deduction. So what is my net initial investment? What is my net initial investment? My net initial investment is 769.60. Check the calculation. Is it right? Is it right? What is the answer? 769.60. This time I'll prepare one more working note. like the previous question, net redemption value. Net redemption value. Net redemption value because I have to pay capital gain tax. Right hand side rupees. Right hand side rupees. Point number A. Point number A, redemption value 1000. Point number A, redemption value 1000. Point number B, current price of the bond. You will buy the bond at this price and redeem at this price. So government will say, oh, only you will make profit. Don't you think you should contribute to this nation and pay tax? Yes. So capital gain 38 rupees. Capital gain will be 38. It will be based on the cost of this bond. So what is the capital gain tax rate in this question? 10%. So you will say capital gain tax at the rate 10%, 3.80, 3.80. And understand, you will get 1000 rupees from the company minus tax paid to the government. So what is your net redemption value? What is your net redemption value? What is your net redemption value? 996.20. Deduct A minus D. 996.20. Correct? So now I have got all the numbers ready. I can solve. So write down, directly write down, or just make one more working note 3. Step 3. Interest net of tax. Interest net of tax. If you have understood, then this is not required, but write down interest net of tax. Right hand side rupees. This is easy. You can skip this working note if you want. Face value is 1000 rupees. Face value is 1000 rupees. Coupon rate is 12%, but this is a semi-annual bond. So interest amount will be, interest amount for 6 months will be, because it's a semi-annual bond, I made you write that, it will be 60 rupees. Okay, but you have to pay tax also on that. So interest amount net of tax 60 minus 30%, 42 rupees, and it is a semi-annual bond. So the number of half years will be 5 into 2. Number of half years will be 5 into 2. So write down formula. Write down the formula. YTM is equal to C plus RV minus P. P for your initial investment, divide by N upon RV plus P by 2, upon RV plus P by 2. Okay. So coupon with tax effect I have already calculated. Coupon with tax effect I have already calculated 42. Redemption value we have already calculated 996.20. Initial investment I have already calculated 769.60. Number of periods will be 10. N is remaining maturity. 5 into 2, 10 periods. 5 year we have to take. Remaining maturity we have to take. Original maturity we don't have to take. So if you want to write this, you can write this also, so that you can revise fast. When you revise, presentation of the answer is very important. That is why I focus on presentation. 5-10 marks extra you will get with correct presentation. Is it right? So can you solve the question now? All figures are available below. Can you please solve and give me the answer? Divya, Roshni, Hari, please reply. So one answer I have got from a student. You are absolutely right, 7.32%. But this is the return for 6 months because all calculations were done for 6 months. So what I'll do, I will convert into annualized YTM. How will you convert into annualized YTM? Multiply by 2. Multiply by 2. So this rate of return is 7.32% for 6 months. So annualized YTM 14.64% per annum. Compounded semi-annually. Compounded semi-annually. See, 14.64% per annum compounded semi-annually. So we have taken problems with tax effect also. Now we'll come to another type of bond which is called perpetual bond. Write down one note in your notebook. Please write down this entire thing. I'll explain also. YTM of a perpetual bond. What is perpetual bond? What is perpetual bond? A bond which does not have a maturity date. It will only pay you coupon. So you buy the bond and you receive the coupon for infinite period. Okay. So write down YTM of a perpetual bond is given by YTM of a perpetual bond is given by. Next line, YTM of a perpetual bond, YTM of the perpetual bond is that rate of discount, at which PV of outflow is equal to PV of inflow. PV of outflow is equal to PV of inflow. PV of outflow means your current price of the bond, am I right? You have to buy a bond today, so write down current price of the bond. And PV of inflow is coupon amount divided by YTM. Is it right? In PV of inflow means coupon amount divided by YTM. YTM is used as a discount rate. So we'll just rewrite the equation. It will become YTM is equal to coupon amount divided by current price of the bond. So this is one more formula. You will add YTM of a perpetual bond is equal to coupon amount upon current market price of the bond. Is it right? So if you purchase a YTM, if you purchase a perpetual bond, you are going to earn a return which is equal to coupon amount divided by current market price. So we have a question on that also. Question number 25. A rupees 100 perpetual bond. We have taken question of all varieties. Some questions are not in the study material, but there is a concept. So we have brought question from different sources. On every concept, there is a question in our book. A rupees 100 perpetual bond is currently selling for rupees 95. So 95 is the current market price. Coupon rate is 14.5%. So coupon amount will be 14.5% of 100 rupees. And the appropriate discount rate is 16%. Appropriate discount rate is 16% is required rate of return. Calculate the value of the bond. So when you calculate the value of the bond, you will take 16% discount rate because your required rate of return is 16. Second is what is the YTM? So YTM will be based on current market price and coupon. Current market price and coupon. And third question is whether it should be bought. So if the YTM is more than 16%, I'll buy it. Is it right? Or if the intrinsic value is less than, if the current market price is less than intrinsic value, then also I can buy. So the last question can be answered by comparing YTM with required return or by comparing intrinsic value with the current market price. Understood? You will be able to solve. Write down first answer, very easy. Step 1, calculation of intrinsic value of a perpetual bond. Calculation of intrinsic value of a perpetual bond. The formula is A upon R. Coupon is 14.50. Required rate of return is 16%. Therefore, the intrinsic value is 90.625. Therefore, intrinsic value is 90.625. Is it right? Any query? No? Okay, now we'll write down step 2, YTM of the perpetual bond. YTM of the perpetual bond. YTM of the perpetual bond is equal to coupon amount upon current price of the bond. Coupon amount upon current price of the bond. Coupon amount upon current price of the bond. Solve 14.50 divided by 95. That is equal to 15.26%. Are you getting 15.26%, Roshni? Yes, you are right. Now the next is, would you buy this bond? Would you buy this bond? So how many of you believe we should buy? Those who believe we should buy, write yes. Yes. And those who think we should not buy, write no. What is your opinion? Classroom students, you should buy. What was your intrinsic value? Intrinsic value, first answer. Intrinsic value, first answer. Please reply. If you don't reply, how will I teach? 90.625. But the bond is trading at 95 rupees. It is expensive. It's overvalued. So we should not buy. Or you can also compare the YTM with the required return. YTM is less than required return. YTM is less than required return. So your answer will be, we should not buy. Okay. So write down the answer, step 3. Step 3. Evaluation. Evaluation, write down. Since market price is greater than intrinsic value, market price is greater than intrinsic value, the bond is overvalued. The bond is overvalued. So one student said, no, you are right. It should not be purchased. It should not be purchased. Overvalued item you should not buy. That is the theme we will follow in our batch. Therefore, it should not be purchased. Therefore, it should not be purchased. Got it? So can we move to the next example now? You can just write one more line. we can also say that since YTM is less than, since the YTM is less than required return, since the YTM is less than the required return, since the YTM is less than the required return, the bond is overvalued, the bond is overvalued, it should not be purchased. The bond is overvalued, it should not be purchased. The bond is overvalued, it should not be purchased. Got it? Now we'll come to next discussion. Is the YTM of a zero coupon bond? So write down this much. Write in the notebook. YTM of a zero coupon bond. YTM of a zero coupon bond. Next line, write down. YTM of a zero coupon bond is that discount rate. YTM of the zero coupon bond is that discount rate at which PV of outflow, is equal to PV of inflow. Is it right? PV of outflow means the current price of the bond, because you have to buy the bond today. Price of the bond is equal to, and already we have understood the PV of inflow is equal to face value or redemption value divided by 1 plus R to the power n. Is it right? Because zero coupon bond will only give you redemption value. There is no coupon involved. Now just rotate the formula, or you can just write a note below, solve and find the value of R. So this R is the YTM. Okay, it is that discount rate at which the present value of outflow is equal to present value of inflow. So this time we will have to solve an equation to find the value of R. Okay, this R is the missing figure. You will be given the price, you will be given the face value, you will be given the number. So you have to solve and find R. Okay, so can we go to the next important question 26. Question number 26. Calculate the YTM of the following zero coupon bonds. There are two zero coupon bonds given to you. Okay, bond X and bond Y. Credit rating is AAAA. Credit rating is a symbol of risk. How much risk is involved? That is not going to affect this answer. Maturity is also same, 5. Credit rating is also same, maturity is same, face value 1000 and second is 50,000. The current market price is 610 and 33245. Both are zero coupon bond. Which bond will be preferred? Without solving theoretical discussion, which bond will be preferred? Yes. So we have to compute the YTM of these two bonds. First we have to compute YTM of these two bonds, and the one which has higher YTM, the one which has, because that one which has higher YTM is giving more return, the one which has higher YTM will be preferred. Understood? So what I need to do? I need to find out their YTM. To help you, the question itself has given you the factor 1.63934 to the power 0.2 and 1.50398 to the power 0.2. So you will use these same values to find out the answer of this zero coupon bonds. Ready? Very easy question. Write down for bond X. For bond X. for bond X, price of the bond is equal to face value upon 1 plus R to the power n. 1 plus R to the power n. So I will put the values, you will solve. Okay, deal done. My values, your answer. 600 is equal to 1000 upon 1 plus R to the power 5. So do you know how to solve it? You will have to write like this: 1 plus R to the power 5 is equal to, take on your calculator, 1000 divided by 600. 1000 divided by 600 on the right side will be 1.63934. Is it there? Then in your next step, 1 plus R will be equal to 1.63934 to the power 1 by 5. This is how in mathematics you solve the equation. 1 by 5 means 0.2. So write down 1 plus R is equal to 1.63934 to the power 0.2, and in the question the value of this factor is given. The value of this factor is given. Value of the factor is given. So solve. The value of the factor is 1.1039. Is it there in the question book? 1.1039. ये फ्लक्चुएट हो रहा है. क्या है वो? 1.1039, and then the answer is R is equal to 10.39%. 10.39%. Got it? Try the next one yourself. For bond Y, formula is same. Price is equal to face value upon 1 plus R to the power n. Question in front of you. Question should be in front of you. 33,245 equal to 50,000 upon 1 plus R to the power 5. Okay. And then like the previous question, you write 1 plus R to the power 5 equal to, take on calculator, 50,000 divided by 33245. So 1.50398. Therefore 1 plus R is equal to 1.50398 to the power 0.2. And this factor is appearing in the question. See the last line of the question. 1.0851 is given. Last line of the question. So therefore, can we say that R is equal to 8.51%? Compare the YTM of these two bonds. Yes. Which bond you will prefer? Which bond you will prefer? Bond X, Divya, bond X. What about Roshni? Bond X. What about other students? So write down the note and conclude the answer. Bond X will be preferred because it has higher yield. Bond X will be preferred because it has higher yield. Bond X will be preferred because it has higher yield. So that was the example on zero coupon bond. So we have covered YTM of coupon bond, semi-annual coupon bond, perpetual bond, zero coupon bond also. Okay. One more practice. Question number 27. Consider a zero coupon bond issued by we know. Oh, face value 25,000, maturity 25-year, current market price is 1792 and yield on similar bond is 11%. Compute bond's intrinsic value. Intrinsic value means present value. So this is 25,000, 25-year, and this is your required rate of return. So you will be able to find intrinsic value. Then you have to compute YTM of the bond issued by we know. So for computing YTM of the bond, you will take the current market price, face value, number of years, and find the value of R. Okay. Give your advice. Same answer. If YTM is more than the required return, we will buy. If the YTM is less than required return, we will not buy. Okay. So can we solve now? Write down first answer. Intrinsic value of the bond. Intrinsic value of the bond means present value of the bond. Intrinsic value of the bond, that is present value, is equal to face value, correct, upon 1 plus R to the power n. So I will give you value, you will give me answer. Let us see who will answer first. Okay, please reply. Anybody who wants to reply? Come on. Just type 25,000 divided by 1.11 and press equal to 25 times. So your answer is 1840.20. 1840.20. You have to do the calculation yourself, na? Got it? 25,000 divided by 1.11 and press equal to 25 times. Now the next question is, what is the intrinsic value of the bond? What is the YTM of the bond? So for that, write down, heading, write down calculation of YTM. Calculation of YTM. Write this heading first, calculation of YTM, then write the equation. Equation is price of the bond is equal to face value upon 1 plus R to the power n. Price of the bond is face value upon 1 plus R to the power n. 1792 equal to 25,000 divided by 1 plus R to the power 25. So now our dear students will solve this equation and give me the answer. Kindly solve. Yes, please reply. We have already done 2 times before this. Okay. So the answer is 11.12%. You can use the factor which is printed in the book. 11.12%. So now you compare YTM with the required return. YTM this time is more than required return, 11%. Other bonds are giving 11% YTM, but this bond will give you 11.12% YTM. So you will say the bond should be purchased. Write a note. Write down, the bond should be purchased the bond should be purchased, because its YTM is higher than yield on similar bonds, because its YTM is higher than yield on similar bonds. Okay, so that was the answer of this question. Roshni, Divya, all of you are right. Now we have studied yield to maturity. One more yield is pending, current yield. Current yield means based on the current market price and the coupon you are going to earn, how much return you are generating. Suppose you bought a bond for 90 rupees and it is giving you 12 rupees coupon. So only you are comparing coupon with the current price. So 12 by 90, how much is that? 12 by 90? 13%, something around that. So you will say the current yield of the bond is 13% based on the current market price and the coupon that you are going to get. So it is the annual coupon payment divided by the bond price. So the formula for current yield is annual coupon divided by current market price of the bond. This I have written in your book. Is it right or not written? It's written in para 21. Today I'll give you few homework. Please note down the homework. Question number 28, 29. 28 and 29, note down homework. 28 and 29 homework you have noted. After that 29th number question, you have been given current yield. So don't write this. This is already printed. Example is printed. Annual interest rate is 15%. Current market price is 97. What is the current yield? So what will be the answer of this question? 15 rupee divided by 97 rupees. That is 15.46%. So that is how we compute the current yield. Now some important points about current yield. In current yield, we ignore time value of money. Suppose it's a 10-year bond, but you have not considered the cash flows at different point of time. You have only considered the coupon and the current market price. Secondly, it does not take into account the capital gain or loss. Suppose the bond was purchased for 95 and redeemed at 100. So there is a 5 rupees capital gain also, that will also affect your return. But this current yield calculation does not take into account the capital gain or loss. Therefore, it is a simplistic measure of yield. It is a simple method of calculation. What is a more appropriate method? YTM. Because YTM takes into account all cash flows. Current yield only considers the annual coupon and the current market price. So it is simple, which does not require much headache, but incomplete measure of bond yield. Okay, but still we have to learn current yield also. So now we will solve question number 3030. Today you find out some time and do all the homework, all of you. If you follow my instruction, we will cover your syllabus comprehensively. All questions from the beginning till date will get covered in your notes itself and in your notebook also. So don't miss out anything. Find out the time and do the homework. Question number 30. Suppose a 9% coupon bond is selling for rupees 112. Okay. With a par value of rupees 100. What is the current yield of the bond? What is the current yield of the bond? Solve yourself. What is the current yield of the bond? So first write down the formula. Current yield is equal to annual interest upon current market price. Annual interest upon current market price 9 upon 112 into 100. 9 upon 112 into 100. Is it 8.04%? 8.04%, write down. Done. Can we go to next question number 31? Consider a bond with following features. Face value of the bond is 1000. Maturity is 5 year. Current market price is 960. Coupon rate is 12%. This time you have to compute two things: YTM of the bond and current yield. YTM of the bond and current yield. So right, first I will solve YTM. YTM is equal to C plus FV minus P upon N upon FV plus P by 2 upon FV plus P by 2. Okay. After writing the formula, please solve. I will give you the numbers. You will solve and give me the answer. This is just for practice. What is the YTM? What is the YTM? Yes, I am asking you a question. What is the YTM? पावर नहीं है क्या? नीचे से जाओ. Check for YTM. So one student is saying 13.06%. Is it 13.06%? There is a small problem with the computer. So you try the next question now. Try the next question, number 32. The previous answer was 13.06. Now try the next question. Number 32. We are trying to resolve the computer problem. Solve 32 number. You can see me, but you can't see my computer right now. 32 number you will try. Power cord देखो जरा. आ रहा है. Please students try 32 number question. In question number 31, current yield is pending. So in question number 31, current yield, write down current yield. In question number 31, current yield was pending. Please write down current yield is equal to annual interest upon current market price. Annual interest upon current market price. $120 by 960 is right now. 120 by 960. 120 by 960. 12.5%. Question number 32. One more practice we'll do. This time we will take semi-annual coupon paying bond, because you have to be careful in the exam. If the institute asks semi-annual bond, accordingly you will solve. A bond has the following features: face value 1000, maturity 10 year, current market price 1120, coupon rate 14% per annum, but payable semi-annually. So I will take 7% as coupon for 6 months, and maturity I will take 10 into 2, 20 half years. Question is, compute the YTM of the bond and also compute the current yield. Same problem, but this time it is a semi-annual bond. You should practice so that you will be able to solve any type of question in the exam. More practice is better than less practice. More variety is better than less number of questions. So please write down the formula again. YTM is equal to C plus FV minus P upon N upon FV plus P by 2. So this time I will take coupon as 7% of 1000, 70. Face value 1000, current price is 1120, and number of periods will take 20. Solve. Yes, please solve. One student has given the answer 6.03%. Very good. Let me check. 6.03%. You are right. 6.03 or 04%. Write down for 6 months. For 6 months. So you write down below. Annualized YTM is equal to double of this. Annualized YTM is equal to 12.08%. Annualized YTM is 12.08%. Okay, this is YTM we got. Now in the same way we will get the current yield also. Please write down heading calculation of current yield. Calculation of current yield. Solve. First I will compute current yield for 6 months. Current yield for 6 months will be interest for 6 months upon current market price. Interest for 6 months upon current market price. Interest for 6 months is 70 upon 1120. Yes, what is the answer? 6.25%. Very good, Roshni. But this is for 6 months, so write down below annualized current yield is equal to 6.25 into 2. 12.5%. Is it right? 12.5%. Is it right? So that was current yield. Now one more important discussion. Institute many times ask you whether you need to buy the bond or not. Already we have done that in some question. So I have made a summary of that in your book. Question number 33, write down homework. Today you will find some time and do the homework. Okay. So those who will do homework will come in rank. Classwork plus homework plus self-study plus revision is equal to rank in the CA exam. Okay. I can take all questions, but then your batch will take 6 months to complete. So case 1, if current market price is more than the present value of the bond, that is intrinsic value, or we can say if YTM is less than required rate of return, both are same. If current market price is greater than intrinsic value, it is equal to YTM is less than required rate of return, we will say the bond is overvalued, do not buy or sell, because overvalued item should be sold, otherwise its price will fall and you will suffer a loss. Second possibility, if current market price is less than, current market price is less than the present value of the bond, it is equivalent to YTM is greater than required rate of return. These two are same. This is equal to this, this is equal to this. We will say bond is undervalued. The decision will be buy. We have used this in some of the questions today. If the current market price and present value of the bond are equal, it means YTM and required rate of return are equal. It means the bond is correctly valued and you should hold. And if you are willing to accept the required return, you can buy also, if you are happy with the required rate of return which is generated by the bond. So overvalued item sell, undervalued item buy, correctly valued item hold. Okay, one more thing, if a bond is trading at a premium, if the bond is trading at a premium, then you will find this observation, if the bond is trading at a premium, YTM will be less than current yield and current yield will be less than coupon rate. This we have already seen. If the bond is trading at a premium, the YTM is less than coupon rate, but now I have also introduced current yield. So YTM will be less than current yield will be less than coupon rate. And if the bond is trading at a discount, it will reverse now. YTM will be greater than coupon rate, that we have already seen. But now if current yield is also introduced, YTM will be greater than current yield will be greater than coupon rate. Understood? So current yield is between the YTM and the coupon rate. And if the bond is trading at par, remember this property, if the bond is trading at par, YTM and current yield and coupon rate all are equal. Very good. So now we'll take one very, very important question. Number 34. This question was asked in exam November 2008 and November 2011, and it has appeared in many RTP, MTP also. Okay, so are you ready? Okay, one more question for today. Based on the credit rating of the bond, Mr. Alok has decided to apply the following discount rate for valuing the bond. Is it right? So Mr. Alok is a smart man like you. He thinks that I will use that discount rate which will depend on the credit rating of the bond. If credit rating is AAA, means highest safety, no risk, he will apply discount rate which is equal to 364-day treasury bill rate. Treasury bill rate means government security, plus 3% spread means plus 3% more, because government bond has the lowest interest. But if you buy a bond of a company, there is a risk, slightly more risk than the government, and therefore he is going to apply 3% more. But if the credit rating is AA, it is also a good bond, good quality bond, but less good quality compared to AAA. So he will apply the discount rate equal to AAA plus 2. And if it is A rated bond, he will apply the discount rate equal to AAA plus 3% spread. He is considering to invest in AA rated bond. So which is relevant for us? This is relevant for us. We have to see how much discount rate he will apply for this. Rupees 1000 face value bond currently selling at rupees 1025.86. This is current market price. The bond has 5 years to maturity and the coupon rate on the bond is 15% per annum payable underlined annually. In your exam they can change it to semi-annually. The next interest payment is due 1 year from today and the bond is redeemable at par. So redeemable at par, but it is trading at a premium. So it's a premium bond. Assume the treasury bill rate is 9%. So treasury bill rate is 9%. AAA rated bond discount will be 9 plus 3, 12%. And AA rated bond will be 12 plus 2. How much? 14%. So our discount rate for solving the question will be 14%. Our discount rate will be 14%. Compute the intrinsic value of the bond. For intrinsic value, I will take 14% discount rate for Mr. Alok. Should he invest in the bond? Compare intrinsic value with current price. If the current market price is less than intrinsic value, if current market price is less than intrinsic value, you will buy. Compute current yield, all in one problem, and compute YTM also. So this is a wonderful question where they have asked you current yield, YTM, intrinsic value and decision relating to purchasing the bond or not. So did you enjoy this question? Say yes or no. Yes. Other student will also tell me, did you enjoy this question? This is very, very important category question. So first write down one small note. Discount rate applicable to AAA rated bond. Discount rate applicable to AAA rated bond. Discount rate applicable to AAA rated bond. 9% is for treasury bill, plus 3% is for AAA and plus 2% is for AA. So we are going to use 14% discount rate. Okay, is right 14%? Okay, next is write down step 2, calculation of intrinsic value of the bond. Calculation of intrinsic value of the bond. 4 columns you will draw: year, cash flow, PV factor at 14% and PV. Solve yourself. The coupon is 150 rupees for 5 year. Redemption is at par. So redemption is 1000 rupees. Yes, anybody? Intrinsic value of the bond? Intrinsic value of the bond. Come on, total of the last column. Any student who wants to reply? First you take the factor 3.4331, 0.5194, then you multiply and you take the total. So please confirm, are you getting 1034.36? Yes. And what is the market price of the bond? Right, current market price of the bond. Yes, 1033.95 is also right. So if you are close to this number, enjoy, you are right. Current market price of the bond is 1025.86. Now compare these two. You are willing to pay 1034.36 and it is available at a lower price. Will you buy or sell? Buy or sell? Quickly, buy or sell? Mr. Alok should buy or not? Current market price is less than intrinsic value. It is available at a lower price. It is undervalued. Write down, buy. So conclusion, write down, the investor should purchase the bond as it is undervalued. The investor should purchase the bond as it is undervalued. Okay, you are getting cheaper. This is what you are willing to pay, but available at a lower price. So next question is, what is current yield? Write down current yield. Current yield. Current yield is equal to annual interest upon current market price. Annual interest upon current market price. Annual interest is how much? 150, and current market price is 1025.86. 1025.86. 1025.86. So it comes to 14.62%. 14.62%. Is it right? 14.62%. One more question. Calculation of YTM. Write down calculation of YTM. Calculation of YTM. Write the formula. After writing the formula, put the values and solve. Try yourself first. Try yourself first. Give me the answer. Anybody who got the answer? Yes, answer please. Anybody wants to reply? So the answer is right. Yes, you are right. 14.3%. 14.3% right answer given by the student. Okay. Now you see in this question, what is YTM? 14.3%. What is current yield? Can you tell me current yield was how much? 14.62. And what is the coupon rate? Is it 15%? Coupon rate is given in question book. Is it 15%? Tell me yes or no. Coupon rate 15% is right?
Yes.
Yes. So if it is a premium bond, YTM will be less than current yield and current yield will be less than coupon rate. You can answer the question whether Alok should buy the bond or not by comparing YTM with the required rate of return. YTM is 14.3. Required rate of return was 14%, 14%. Since the YTM is greater than the required rate of return, you can buy the bond. Okay. So write down one note. YTM is greater than required rate of return. YTM is greater than required rate of return. The bond is undervalued. The bond is undervalued. The bond is undervalued. Investor should purchase the bond. Investor should purchase the bond. The bond is undervalued. The investor should purchase the bond. Is it right? The investor should purchase the bond. This way also you can answer. So this was a very good question. It covered lot of concepts in one single problem. Question number 35. Very easy question. Write down homework. It was November 2009 exam for 4 marks. Based on the concept that we have learnt, you will be able to solve question number 35. So this question also you note down as homework. Okay. So now we'll continue tomorrow. Thank you very much. We'll see you tomorrow. Bye bye. Tomorrow we'll continue. Okay.